Well, welcome to Investor in the Family Radio. This is Brian Bain, your host, and I'm so excited to be back with you here today. For our regular listeners, you'll may be thinking, what is this podcast that just showed up in my phone? Because I haven't seen a podcast from Brian in a long, long time. I actually looked back at my podcast list, and it's actually been, I think, since August or September of 2017 since you've last heard from me. So I am thrilled to be back, and some of you may be wondering, some of you have contacted me, hey, Brian, where's the show? I miss it, which is awesome. I miss you too. But I basically, short story, I won't get into all the details because it's not super interesting for you probably, but building a business can be challenging. And kind of what I found out was I've been working for a while to build a business here through Investor in the Family. And I was taking a lot of time from my family to build a business that wasn't bringing in revenue. And so basically I was stealing from my family to give to you guys, which obviously I love giving to you guys, and I'm going to continue giving to you guys. But until I had some kind of a system in place to help balance it out with some revenue, I wanted to kind of figure that out before moving forward. And so I think we've got some things going here, which I'm excited about. But again, more information than you need. But bottom line is we've taken a break for a little while, but we're back and could not be more happy. And really fun news. We actually have a guest on with me today, kind of a guest co-host for the day, David Reyes. Say hey, David.
Hello, hello.
And David is a friend of mine. David, how old are you? Full disclosure.
So I'm 26. I'll be 27 this year in April. So it's always kind of when people ask me that, I don't know if it's better looking if I say 27 or 26, just so 26 right now.
Struggles of youth.
I know. It's just
older people have no problem with that question. You always err toward the lower end, but it's kind of like
exactly.
You have a toddler. They're not 2.5, they're 2 3/4. So,
right.
So David
can't say my month. So
are you 26 3/4 then? Is that what you are?
Yeah, 20. Yeah, getting pretty close to 27. So crazy.
Okay, cool. Well, David, I invited David to join us on the show as a co-host for this episode because we've had a lot of fun conversations about different things in the past and found out that David does not have much investing background. And I thought it'd be really fun to bring someone on the show to dialogue through the content, whatever it may be. Today, we're picking up again where we left off on the Warren Buffett's letters to the shareholders of Berkshire Hathaway. Today we'll be covering the 1971 letter. We dropped off in 1970 back in this last summer. But I thought, let's bring on someone who does not have a lot of investing background so we can have his experience kind of balancing out my experience and his questions to kind of really help flesh out a lot of, I think, valuable lessons here that some of us that are more experienced may gloss over, which is not good. And then also bring out questions that some of us that may not be as experienced, may be wondering, but weren't being covered before. And also, I think it's just more fun to have someone else in the show. So David's here with us, which we're excited about. So thanks for being here, man.
Yes, sir. Thank you for having me.
And so what we're going to do is we're just going to kick this off and we're going to pick back up with the 1971 letter. And I think the plan is, I hesitate to commit to too much stuff right now as we're getting back into the show, but I'm thinking for the next we're probably going to go through the 1971 through basically go through the 70s, one letter at a time, one show at a time. And then we'll take a little bit of a break again and focus on another topic for a little bit, then maybe come back for the 80s and stuff and work our way through, just to kind of keep things fresh. Because what I find as was getting back into these letters is, first of all, it's just so refreshing to get back into this content because, actually I was thinking, should we go one letter at a time, episode at a time? Is that spreading them out too much? Is there enough content per letter to really get into? But every time I do it, I find out that there is, because there's just so many great reminders and little nuggets of gold that can be missed if we rush through the process too much. So, anyway, so we're going to jump in with the 1971 letter. And I think as we do that, we'll start bringing in a lot of those kind of recurring themes that we've been discussing, starting back in the 1965 letter through the 1970 letters. There's some core themes that we're shaping up around what we've been learning, and we'll start kind of bringing all those back into the play as we move forward. So I'm just curious, David, do you have anything you want to say before we get started? Just kind of put you completely on the spot, or should we just dive in?
So you were talking about how you love diving into this content. I'll be honest, I've heard of Warren Buffett, obviously, just being, people often ask who's the, wealthiest man in the world, or, I feel like his name's always comes up. So, you were talking about having no prior experience in this. So in the circles I run in, this book these letters aren't commonly, attributed to. And so it's kind of funny how you're so excited. So I'm coming in kind of with completely fresh eyes, I would say. And so I'm excited just diving into some of these. But just kind of knowing from where I am, I'm excited to kind of hear your thoughts on these as well.
Well, tell me this. So, I gave you a little bit of homework. I had you read the 1965 to 1970 letters, obviously in addition to the one we'll be covering today. I'm curious, and no pressure. I mean, if it's like nothing or negative, that's fine. Like, what did you think about those letters, and did you find them interesting? Did you find like them instructive and from an investing standpoint?
Yeah, I think it really helped me capture, I would say, I guess the essence of why these letters exist and why it's important for these shareholders to have this information. I kind of at first would see it kind of as a memo, kind of as a, hey, here's just something to file away. Here's just something to kind of read through kind of over time and kind of come back to. So that's kind of how I saw the thing that I really liked most is just the ways that he would talk about maybe struggles in a certain area or the wins in certain areas. And so I really like kind of the organizational communication side of that. But as far as the numbers and the percentages, they didn't really have much emphasis to me because I wasn't like, oh, okay, this is something that's helpful. But it was interesting to kind of see it as it changed year to year.
Did you, and again, this may be asking beyond what you feel like your pay grade is right now, but in terms of like, did anything stand out to you in terms of how he started running the business, or do you feel like you have a proper background in terms of what was going on when he started writing these letters and the kind of context of what he's trying to do?
I really don't, other than the letters to shareholders, just kind of giving it information and things like that. And so, yeah, I guess I wouldn't understand the complete background of that. So that would be helpful for me.
No, sure. Well, and also you're working out of, for anyone wondering, sometimes if you go online and find the Berkshire Hathaway letters to shareholders, actually some of them are not as easy to find as they used to be. I guess people have taken them off the internet or maybe they've been forced to. But if you go to the Berkshire Hathaway website, I think you can get letters starting in the late 70s up to date. But if you want all of them, if you work hard enough, you can probably find them piecemeal around the internet. But there's a book by, I guess, Max Olson, I think is the guy's name, that, I mean, it's not by him. He just basically collected the letters together in a big, huge book. And so you can buy that book on Amazon, or you can actually link to it from the Berkshire Hathaway website or the Invest in the Family website. And I can get a little bit of a commission. So you should do that. That'd be awesome. In the beginning, the front of the book, it gives a little bit of context and stuff, but it talks about, what pages? Early on, it shows like all the different companies that have been acquired by Berkshire Hathaway since Warren Buffett became involved in 1965. Because today, when you hear Berkshire Hathaway, most people will think of obviously Warren Buffett's company, and you don't think anything about a textile company. Because first, most people today think, well, what on earth is a textile company? Today, when you hear of Berkshire Hathaway, you think of this massive investing conglomerate, basically meaning this company that owns all or a portion of lots of other companies and makes money off the income from those companies, basically. But it didn't start that way. And that's one of the reasons I'm enjoying this series is we're looking at, okay, there's almost no one who wouldn't think, I would love to be, from an investing standpoint, where Warren Buffett is today. I mean, personally, tens of billions of dollars, and as a company, hundreds of billions of dollars of value and worth that have been created from, relatively speaking, a really, really small amount of money back in the 1960s, at least when Berkshire Hathaway started. So how did he get from there to where it is today? And that's what we're tracking through in this series, walking through all these letters. And so back in 65, that first letter, I can kind of give a brief overview. You got Warren Buffett coming in, and he purchased what was at that time simply a textile company, meaning basically they make fabrics and stuff. And honestly, I'm not an expert in textile stuff, so someone out there may be an expert thinking, no, Brian, you're getting it wrong. Sorry if I'm getting it wrong, but they basically made fabrics and different textile type things, for making, I guess, clothes and fabrics and and things related to that industry, which obviously is not something that sounds super exciting. But
I was going to say it's super, super riveting stuff.
Yeah, I know. I know. I can hear you drooling over your microphone. It's
textiles. Yes.
Yeah. Why, I'm wearing clothes. Are you not wearing clothes?
That's true. Yeah, they get them from somewhere.
Exactly.
That's good.
You know. So there you go. And then but at the time, and as you read throughout all of the letters we read so far, the textile industry was doing really bad. And so Warren Buffett's coming into this company, and it's from almost day one. It's like, how do we salvage or make the most of what appears to be probably even a bad investment, maybe? But what I started to see with this, saying, hey, here's a great model for all of us as individual investors, because I know most people listening here, we got professionals listening, which is awesome. Wave to the professionals. But a lot of people listening are individual, whether you say DIY investors or retail investors. People are looking to invest their own money to provide for their own families or just for themselves, and which is awesome. And so for us, as I started reading through these letters, you start seeing, hey, here's a great model for what it means to run a business well. And I am a huge advocate of viewing your household as a business. So David, I know you're married. I'm married. I've got a couple of kids. And so thinking about my household, it's a business. And so think about it. Okay, I've got an income stream through my job. And maybe there's additional income streams that are being created through side business or something like that. But then I've got operating expenses, which are, food bills, gas bills, insurance, utility, all that kind of stuff, groceries. And so when we mesh all that out, like, I'm running a business, and at the end of the day, I want to have net income. I want to have more revenue than I have expenses. Otherwise, I have to borrow money, which gets into debt, which gets problematic and expensive, and all that kind of thing. So, and what you see Warren Buffett doing is he's coming into an unhealthy business or a business that's struggling and trying to make it healthy. And so wherever we may be personally in our own, I'll say, investment businesses or our households, I can use those interchangeably, we can get a lot of lessons from Buffett and how he started building Berkshire Hathaway as to how we can get our own house in order financially if needed. Some of us may be in great shape, which is awesome. And then begin building out our investment business. Because again, he bought a textile company that decades later became a massive, incredibly respected investment, big conglomerate. But it started as a textile company. So today we're starting as our own individual little households or investment businesses. But who knows what that can become over time if we are willing to commit to some of these time-tested investing principles and lessons learned from Buffett. And so so that mindset itself, first of all, is key. And then I can talk about a few other things. But I'm curious, when you hear that, do you think, hey, that's pretty cool? Like, man, I don't know what you're talking about.
No, I think it really does help, because when you look at, okay, if I'm starting in, trying to understand investing, trying to just understand kind of the background of this, I want to enter in a little slowly, just because it's one of those things that you're just not sure about. You see big numbers and you see things like this, and it, for me, it could kind of be a little scary to come into it. And when you're like, okay, let's read, the best of the best here, and you're looking at this, you're like, okay, this doesn't really relate to me. But I think, and really what I'm kind of sensing you say is kind of reading through these things really gives you almost a picture of what really this success can look like, and really from a large scale, and coming in and someone who's well known, but looking at how we can even take the small things that we're doing and make them great in the range that it needs to be, I guess, in the range that it can be. Because I think it's really easy to come in and saying, well, I'm never going to be Warren Buffett. I look at this and I'm like, this is insane. If I'm starting out, why should I look at Warren Buffett? But I think it's exactly what you're saying, kind of that progress and kind of that, starting from a really struggling place, a really struggling business, and growing it into what it is. And that really helps.
Well, and that is helpful, because that perspective is so helpful. Because I was interviewing someone a few weeks ago, and he's already retired, and he focuses a lot on like kind of retirement income from his investments, which I won't worry about explaining right now kind of what he means by that. But basically, a lot of times when we talk about retirement, people think, well, okay, what's your number? And I don't know if that comes from, I remember there used to be that commercial, what's your number? It's $1.6 million, whatever else is what I need to retire and have the money that I need for, to finish my life out or something like that. And some people think about, man, that's so intimidating. Okay, my number is 1.4 million or whatever it may be. And you think, well, right now in my investment account, I've got and I'm making, like, say I've got $40,000 or something like that. Like, how on earth am I ever going to get to that number? It's so overwhelming. But what this friend of mine a while back, when I interviewed him actually for the most recent investing summit, he said, it helps me to not focus on the number, but focus on what do I need to live off of, basically, and then try to find investments that generate that income. And it's a different way of kind of doing the same thing, but that way you're not building some massive crazy nest egg, but you're trying to kind of build a more realistic stream of income to fund your retirement. And I think about with Buffett, we can look at, okay, he's worth tens of billions of dollars, which I can't even make sense of that number. Like doesn't even like compute to me, like I remember there's someone, having a conversation a while back about, some people who are in the oil and gas industry and, they have personal wealth probably in the 9 to 10 digit figure number, like $1 billion type stuff. To that person, like spending $300 on something is like spending a quarter to them. Like the relative net worth expense is like me spending a quarter on something, you know what I mean? Like, and actually I may even be getting that proportion wrong, but it's just, I can't compute how insane that number is. But what I can compute is I may not be trying to make tens of billions of dollars, but what do I need to provide for my family? What is that number or that ongoing revenue? And then focus on the lessons from Buffett to get to where I want to be as opposed to this astronomical, insane place.
Right. And I think it's all, as they say, trust the process. I mean, that's kind of a familiar term. And I would say for me coming in as a, millennial as kind of the buzzword there is, I talk to a lot of people, around my age, kind of coming into their full-time jobs, kind of settling into their career early on and really just trying to figure things out. I've been married only for a couple of years. And I think, last night I even asked my wife, okay, because I always just like dreaming. And so I'm like, okay, say we won the lottery, what would you spend it on? And so, it was funny you talking about those numbers. We were just kind of thinking, okay, what would we pay off? What would we do this? And then we dream a little and we're like, wow, this sounds really awesome. And then you kind of forget almost where you're at right now. And so I kind of got to the point where it kind of leaves you a little depressed because you're like, oh man, and I wish all my debt was paid off. I wish all this stuff is done, but really how rewarding it is, those little wins. Like for me, like just this past week, I filed my taxes and I felt like I was king of the world because I finally got that off my shoulder. It was something that it was just kind of there.
Sure.
And so I'm just little things like that just can kind of get you where you're going. And so I really do think that process is something that is hard to kind of just sit down and say, okay, I really want to understand this, but to understand it from someone who has done it really well, it's like, why reinvent the wheel?
Absolutely. Well, and also realizing that I think because it's so natural for us, and I mean, even we're kind of pressured a lot of times to think and focus so much on today and short term, we forget that like a lot more is possible over time than we naturally think. I know a mentor of mine, has said, we overestimate what we can do in 3 months and underestimate what we can do in 3 years. And you can play with those time frames all you want, but it's so true. Like we think, I want to get all this done, but I want to done it now. And then you don't accomplish it and you get discouraged and you quit. But if you realize, man, if I just extend that time frame, I can accomplish most of what I want to accomplish over time,
right?
And actually have a better experience than trying to do it all at once. And actually was running some numbers. Like one of the things I've done recently is I've started a kind of a subscription service called Capital Allocation Mastery, and the whole idea is to kind of help people become, I say, masters of capital allocation, and then which really pulling a lot of things out of what we're learning from Buffett, but. I was crunching some numbers on there and I realized, so if someone was starting with a small retirement account, say about $12,000, and in 20 years, and say they wanted to add $5,000 per year, because that's approximately the limit for adding to a Roth IRA retirement account, you can add about $5,000 a year. And so if you start with about 12 and then added $5,000 a year for 20 years, and if you wanted to retire and then draw $100,000 out of that money per year, if that makes sense, and to live off of, you could achieve that if you had annual returns of 14.84%. which to you may not mean anything because you're not used to talking those numbers. But historically speaking, the overall stock market, got a little bit of a congestion. The overall stock market, it usually averages between 8 and 10% per year historically. And so you think, okay, that is what it is. But if you can make about 14.84% on that scenario I just described, you could retire in 20 years and pull $100,000 a year out of that retirement income for 30 years, right? So you can have basically an ATM paying you $100,000 a year for 30 years off that investment if you made 14.84% per year, which doesn't sound, again, depending on people's background, you may think that sounds impossible because beating the market's really hard. And you know what? I think it is really hard for a lot of people. And I'm not acting like I've got some magic solution to that. But I do believe that most of us sabotage ourselves from day one because we believe all of the rhetoric out there that beating the market is hard and impossible. And it is hard, but it's not impossible. And that's part of what we get out of, from Buffett is it can be done. And people are like, oh, well, Warren Buffett did it. But Warren Buffett, I think historically his returns were around like 19%, which you're going to think, oh, that's only 5% different than 14.84. But another thing is, man, 1% difference in terms of like making 15% per year versus 16% per year is dramatic down the road.
Yeah.
I don't know if I have the numbers in front of me. I may pull them up here in a minute, but we'll maybe say that for later conversation. But the point being is achieving some of those goals where we want to be. My thesis is it's actually more attainable and probably involves less risk than most people think.
What would you say to, I guess, people in my generation, or people in, my age range, people just kind of getting into this who say, you know what, like, I just want to, I don't care about money. I don't care about that. I just want to love what I'm doing. And, and then they start kind of realizing, hey, this is down the road. It's just you can't really work. You can't really love what you're doing if you have to have this. And so I guess, because in the conversations I have with people about this, most people are like, I don't want to think about that yet. I don't want to think about that yet. But I feel like it's like this is the best time to think about this stuff when you're younger because it's going to pay off so much more. But like, I don't know, I guess what would you say is the biggest difference between kind of Warren Buffett's this era and maybe the era that we're living in now and how people view this stuff?
Well, I wouldn't say it's necessarily a difference in era. There's a little bit of it because, I think today people are even more immediate gratification focused than probably back in the 60s and 70s. That's obviously some of that's just human dynamic, but it's definitely more so today because we're so much more heavily and constantly marketed to think about have what you want right now. And then also I think a lot of, in the millennial generation, there's a lot of jadedness toward investing because of, it's viewed as evil capitalism. And then also the big financial crisis we've had, I think impact has, they may not have felt it personally, but it's in the back of people's minds in terms of, well, why would I do that? Because you're just going to lose all the money anyway. Maybe they saw a bad experience with their parents, but here is why what you just said is so beautiful. So I've got an investment calculator in front of a retirement calculator on my computer in front of me right now. And let me see. Okay. So for you, say you're 27, say you want to retire at the age of 60. And I'm just making, say your annual household income is $50,000. Okay. I don't know what it is. I'll actually just make it 45. Let's bring it down a little bit. So your annual income is $45,000 and you want to save 5% of that per year, which works out to like a little under $2,500 per year. And you're going to put that aside. And right now you have $1,000 in retirement. Okay. So in summary, you're 27, you have $1,000 right now saved for retirement, and you want to add about $2,500 to that a year, approximately. And then you want to get paid, basically you want your income back. Then you want to get paid $45,000 per year in retirement, which may not be enough, but I'm just, based upon what you're making right now. Okay. So let me think. So if you made just 10% return every year on the income, you would, let me see, at the age of 90, you would die with $3.5 million left over.
Wow.
I know that's hard to get your mind around when you can't see it in front of you because I'm just talking, but that's not like making 10% per year is actually very reasonable
Yeah.
for someone who has a good plan and the discipline to stick to it.
Yeah, and I think also and what I've noticed too, and I think a lot of it I'm burned by is just people that like want to like you want to say I'm wanting to get interested in this. I want to start this. I'm talking to maybe a financial person, things like that, and it's really easy to kind of what's in it for them. You know, they start contacting you and saying, hey, we want to help you with this, and and I have a lot of friends who send me Facebook messages, but they're not really my friends. You know, it's kind of those guys that I was friends with on Facebook, and they're like, hey, I'd love to grab lunch with you, and you're kind of like, okay, what's in it for you type thing. What are you going to try to sell me? But like, and I think that's what kind of burns you is because I'm like, I don't want to get into something. I just want someone to kind of help train me, help teach me. And I think there's not a lot of that going on right now because it's all about, hey, well, let me, something's in it for me here if I'm going to really train you in this way. And so I think it kind of scares a lot of people off.
No, I completely agree. Well, and for most people, it's like this big black box. Like, I don't understand it. And like you said, you sense an ulterior motive in that other person because,
right.
Obviously they're incentivized to get you to take an action, which means on some level they're biased. And so on some level you think, well, can I fully trust this person to have my best interest in mind? And obviously there are a lot of financial advisors and planners who are great people and generally do have your best interest in mind. But, not everyone is that way. And There is a reality that, and I've got a lot of friends in the investment advisory space who affirm this over and over again. I mean, for a lot of people, to be a successful investment advisor, it means getting more clients, not necessarily getting them great results. Obviously, great results leads to more clients potentially, but a lot of investment advisors are really just good salespeople who then hand your money off to someone else to manage it.
Right.
And so the person you're talking to may not actually be a great investor themselves, which is kind of the irony of it.
Yeah.
Then they're charging you a fee and then giving your money to someone else who's charging an extra fee. And again, that doesn't have to be a bad situation, but you need to understand what's going on. But so let's take that exact same financial scenario that I just shared. So for you, this is the power of age. So for you at the age of 27, given those dynamics, if you want to retire at 60 and get paid $45,000 a year, which may not sound like much, but just based upon what I'm making up for current income, starting with only $1,000 right now and only adding $2,500 a year, you could retire at 60 and live for 30 years off that income and still have $3.5 million left. But someone like me, who is around 40, all I'm changing is the starting point. I would run out of money at the age of 64.
Wow.
That's the power of age. And that's the reason why people in the financial world, ulterior motives aside, and people like in my role, it's like, man, if you just start early with like anything,
yeah,
and you have a decent plan and you don't mess with it too much, then you don't have to be super creative to do really, really well.
Yeah, and I think that's what's kind of hard is because I always hear that is like start early. When you get your first job or you kind of start, you're thinking about your 401k and you're thinking about all these numbers that are, good and stuff that you need to do. And you're just like, okay, I'll start, but I don't really know what to do. And, it's hard to know who to look for. And so I think looking at, going back to these letters are things that's a great starting point to kind of look at a big scheme of things on that stuff.
Right. Well, and again, it communicates that there genuinely is the idea of slow and steady wins the race. And something else Buffett says is, there's a book that you and I will talk about eventually, I'm sure, called The Intelligent Investor, written by a man named Benjamin Graham, who you probably never heard of before, but he was an early mentor of Warren Buffett's. And Warren Buffett, I've got the book here in front of me, let me pull it out. He has a quote at the top of the book saying, by far the best book on investing ever written. So obviously when Warren Buffett says that, people take note. And the people who have been in the investing world for a while would be very familiar with this book. May have not have read it, but at least familiar with it in general.
Right.
And Warren Buffett writes an introduction, and that I've quoted this so many times. My listeners probably, like, their ears are bleeding from listening to me say it. But he says in the preface, he makes this comment. It says, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. It doesn't require all those advantages that people may naturally think. What's needed is two things. One, a sound intellectual framework for making decisions. So basically, you need a good plan to guide your decision making as an investor. And two, the ability to keep emotions from corroding that framework. He said those two things are all you need to invest successfully over a lifetime. And so, but the thing is, almost all people, most people, if they're honest, don't actually have part one, a good plan. And anyone who does have a good plan, most people completely destroy it because emotions, they get greedy, they get fearful, they panic or whatever else, or they just get impatient and start making decisions to undermine what's going on. And even just like I was reading, again, we're kind of getting ahead of the game a little bit, but I was reading, I think, the 1973 or 74 letter last night preparing for today. And Buffett talks about, years going by with an investment not performing like he wants to, but he believes in the long-term impact of it, so he's sticking with it. Most people don't do that. And what was the other thing I was going to say on that? Oh, one of the great things too is there's another guy named Peter Lynch, who was another really famous investor. He managed a mutual fund with a company called Fidelity for, I don't know, it was 13 years or something. And if I remember correctly, the annual return on that fund was like 29%, which is utterly astounding. Like, I mean, I mentioned, Buffett over his career has averaged like 19%, but like 29%. I mean, if we did ran numbers in the calculator, it would like blow your mind how quickly that accrues a lot of wealth. But the thing is, according to this study that I read about, the average investor in that fund over that period of time lost money. Because they kept jumping in and out. Oh, the fund's going down, I want to get out because I don't want to lose money. Oh, the fund's going up, I want to get in because I don't want to miss out. And it's the classic investing idea that people buy high and sell low, so you're constantly overpaying and constantly getting underpaid when you sell. And so, again, classic investing wisdom and advice that most of us, if we're honest, fail to follow, so we actually sabotage ourselves. So even when a very simple plan can lead to the results that I mentioned to you a while ago, retiring with dying at the age of 90 with $3.5 million left over. But most people never get there because they fail to follow those two recommendations of Warren Buffett.
Well, and it's funny because, if you were to ask me before, what do you think Warren Buffett says are the two most important things that are to become a successful investor? I would instantly think, well, probably have some sort of, really good training in business and in math or something, and must have been a really good math student and must really know how numbers and know the economy and things like that. And so that's what I would say. And so it's kind of surprising that those are the two things that he says that you need.
Well, and I think about it like this too. Like you think about, any profession out there, and whether it be doctors, lawyers, it's people in the business field or whatever it may be. Like, and then think about your peers. You probably have friends who either are, maybe they're doctors now, or they're in medical school on the way to be doctors, or same with law school, and maybe in the business field and endless number of other professions. But you think about it, okay, those people who are now becoming professionals or are professionals, and for me, it's even more so being around 40, a lot of people that I know in other industries are becoming like leaders in those industries, which is kind of a weird dynamic to start see happening. But you realize, okay, I knew you in college, or I knew you in high school, and I mean, you're great, but there's nothing exceptionally amazing about you per se.
Yeah.
Or in some cases, kind of like, wow, I can't believe you're actually successful. You know what I mean?
Exactly.
And so, but you realize that in any field out there, there's a whole range of what success means. Like I've got a member of my family who's been a physician for a long time, and I could ask him, okay, I'm sure he would say that there are physicians that he has tremendous respect for, and they're off the charts amazing. You believe and trust anything they say. But there are a lot of physicians who are like, I won't go to you because I don't trust you. But generally speaking, we hold doctors in high regard. I guess my point in all that is that in any field, there is that extra dynamic of there aren't many people who are really willing to go the extra mile. There aren't many people who are willing to pay the price and be disciplined to do what it takes to actually succeed. You can go the motions and still be a doctor. You can go the motions and still be a lawyer and have decent success. But if you really want to be exceptional, it really probably involves a few extra disciplines, but most people aren't willing to do it. And I think investing is the same way. I'm not sure if the illustration helps or not, but
no, that really does. And I think it goes to remind you that, I mean, discipline in anything. I mean, go back to the quote you said, we overestimate and we underestimate. I mean, we kind of go with the goal in mind. I mean, you take New Year's resolutions, for example, by this time, they're probably all shot, and it's kind of, you need this new wave. You need something fresh. And so I think things like this and trainings and surrounding yourself with good community that kind of help you and have good conversations around you can really help that put that into focus for you.
And I love that you shared it exactly the way you did. And I was totally not set up that way, but that is exactly the way what I want this podcast to be for all of us. Kind of that community, as well as other stuff with Investor in the Family. But I want it to be that community for kind of like renewing our minds around, okay, this is where I need to focus, because everything around is constantly the newspapers, anything in the investing world or anything like that is constantly trying to motivate us to take some kind of action, because that's how most people in this space make money, is through us buying and selling stuff or doing whatever else. But that's usually not good for us. And so I kind of view this podcast as kind of like that sounding board for us to kind of have our minds regularly renewed and refocused on healthy investing disciplines to help us stick with it over a lifetime. And so in this sense, kind of with this podcast, this community can kind of be each other, kind of our best friend or accountability partner to be successful investors over a lifetime.
Right.
And with that, I think I'll still go and wrap up this episode now, because I think, we didn't get into the 71 letter, but we'll just do that in the next episode, because I think this actually turned out to be a really great kind of reintroduction into what we're doing through these letters. And so we're going to call it a day on this episode, and then we'll jump back in on the next episode and actually we'll kind of probably do some more review as well, but then jump into the 71 letter and kind of get into some more nuts and bolts there. But as always, thank you everyone for listening. You can visit us at investorinthefamily.com. Hey, and David, good job, man. Thanks for being here today.
Yes, it was good to be in, and it just goes to remind you that anybody can talk to anybody about investor. I didn't have to have a business degree. I only took one math class in college, Brian. And so getting to be on this podcast is kind of an honor, and something if you would have told me back in that math class, I would not have believed you. So it's just an honor to be able to have conversation about this. Well,
it's been a lot of fun too. And you know what? I'm going to bring you back to the next episode, so no reason to say goodbye.
Hey, I love it.
This is awesome. You've done great. And hey, everyone, we'll talk to you soon. Thanks. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.